Welcome back to Iron Financial. Look, this is the channel where we help you forge a decidedly stronger portfolio, and we do it by cutting right through the market's weakness with cold, hard data. If you're seriously committed to building unshakable, generational wealth, do yourself a favor and hit that subscribe button right now. In today's explainer, we're dropping the absolute sledgehammer on what might just be one of the most explosive earnings reports of the entire decade. Right now, the momentum of the entire market is basically hinging on AI infrastructure spending. That makes this specific report a critical bellwether for the broader global economy. Dell Technologies just posted an absolute blowout for their first quarter of fiscal 2027. We're talking about a massive 88% revenue jump. That jump literally sent the stock surging 27.6% in a single trading session. Guys, this is not just your standard earnings beat. It's a structural earthquake in the technology sector. But look, before you rush in to buy the roof, we have to stress test these numbers. We need to determine definitively if this is an ironclad opportunity or a devastating market trap. Exactly. Let's take a breath and not let the hype completely blind us here. A 27.6% massive post-earnings surge in a single day, that is exactly the kind of wild price action that brings literally every momentum trader out of the woodwork. I'm here to represent the folks at home who are asking the hard, necessary questions. Is this massive surge a truly solid portfolio foundation, like something you can actually build long-term wealth on? Or is this just phantom AI scaffolding that's just waiting to crack the second it's put under the pressure of macroeconomic reality? We have to remember the actual environment we're operating in right now. Persistently high interest rates are squeezing capital left and right. Enterprise IT budgets, they are severely tightened across the board. And historical hardware cycles are absolutely notorious for booming abruptly and then busting just as violently. We desperately need to know if the underlying steel here is actually as strong as those flashy headline numbers suggest, or if we're just staring at a cyclical mirage. Well, to really understand the strength of the steel, you have to look directly at the blueprint. We're setting the baseline right here to brilliantly illustrate Dell's total structural pivot. Listen, they're no longer just that legacy PC builder from the 1990s, pushing low-margin consumer desktops out of college dorm rooms. No, they have engineered a massive, fundamental transition into a high-value, high-margin AI infrastructure powerhouse. They are actively building rack-scale enterprise data center solutions. This AI opportunity is fundamentally transforming the entire company from the ground up. And to prove it to you, we're going to do a hard drill down into the raw Q1 2027 financials. The numbers they just dropped absolutely prove that their engineering leadership and their highly differentiated AI solutions are actively winning massive, incredibly complex contracts on a truly global scale. All right, let's drill down into the concrete data. Just look at these top-line numbers. Total revenue came in at an all-time record of $43.8 billion. That is up 88% year over year. Operating income, it absolutely skyrocketed by 154%, hitting $4.2 billion. But the absolute sledgehammer on this slide is the bottom line. Non-GAAP diluted earnings per share exploded by an unbelievable 214% to $4.86. We are looking at a rock-solid money-printing foundation right here. The critical takeaway for us is why profitability is scaling so exponentially faster than revenue. It implies massive, massive margin expansion. Dell is flexing immense pricing power. They are shifting their sales mix heavily toward premium, high-margin AI servers, and they're doing all of this while maintaining aggressive, strictly disciplined cost controls across the entire organization. So this isn't just growth for the sake of growth. It is highly profitable, structurally sound growth. Now, let's actually break down who is doing the heavy lifting here. Dell's overall business is basically split into two main pillars. The Infrastructure Solutions Group, or ISG, completely carried the quarter. They posted a 181% revenue surge, bringing in $29 billion. Keep in mind, that is 8 consecutive quarters of double-digit or better growth. It's a machine. Now, on the other side, you have the Client Solutions Group, which handles the commercial and consumer PCs. They brought in $14.6 billion. That's a 17% growth rate. So what is driving that sturdy, albeit slower pillar? We are finally seeing the dawn of the AI PC refresh cycle. Combine that with massive corporations suddenly realizing they absolutely must upgrade the aging fleets of laptops they bought way back during the pandemic era. The PC market provides a really sturdy floor, sure, but ISG and their advanced data center architecture, that is the reinforced titanium driving this massive structural expansion. Okay, let's stress test these numbers for a second. I definitely see the bullish reality on the left side. Dell's management was highly touting an AI customer base of over 5,000, and that's growing more than 50% in just 6 months across neoclouds, sovereigns, and standard enterprises. Just to break that down for the broader audience really quickly, sovereigns refer to entire nation-states that are actively building out their own localized, highly secure AI grid. Meanwhile, neoclouds are those highly specialized, incredibly well-funded AI startups that are just gobbling up compute power. So yeah, that sounds like an incredible blueprint on paper, but the bearish challenge on the right, that's what I actually care about. Can their supply chain actually handle the load? You can have a massive backlog of 5,000 skyscrapers waiting to be built, but if you don't actually have the materials to pour the concrete, your structural integrity is completely compromised. Are they just taking on orders they ultimately cannot fulfill? Well, the data definitively proves they are fulfilling them. The ultimate proof is the $16.1 billion in recognized AI-optimized server revenue for this quarter alone. Think about that. That is an almost 800% growth year over year. Dell isn't just taking flimsy paper orders and handing out empty promises. They are successfully pushing heavy, highly complex steel out the door right now. They're building incredibly complex designs. They are actively transitioning to NVIDIA's new Blackwell architectures, which, by the way, involves manufacturing incredibly intricate, liquid-cooled racks that are notoriously difficult to physically assemble and ship. And yet, they are recognizing massive tangible revenue in the process. They are unequivocally proving their execution capabilities at scale. Mark, pushing some steel out the door today is one thing, but let's take a hard look at what is still sitting in the yard waiting to be built. Dell exited the quarter with a record $51.3 billion AI server backlog. $51.3 billion. That is an astronomical figure. My main question is, are these ironclad multi-year supply arrangements, or are these just phantom orders? We have seen this exact dynamic play out in past tech cycles. Think back to the Cisco networking hardware boom of the early 2000s, or even the massive pandemic-era PC double ordering phase. Customers routinely double or even triple order when supply is dangerously tight, just to desperately secure their spot in line. The moment the bottlenecks hit or the macro environment shifts even slightly, those multi-billion-dollar backlogs evaporate overnight into thin air. How solid is that $51.3 billion foundation really? And just to further prove my point, let's look at the cracks in the armor, straight from the chief architect's mouth. COO Jeff Clark literally stated on the earnings call that demand continues to brutally exceed supply, with memory acting as the primary constraint. He openly admitted that they are operating in an inflationary environment that is changing at an absolutely unprecedented rate. Why are these prices changing so violently? Well, because there are massive structural bottlenecks at TSMC foundries right now, and there is a fierce, cutthroat global bidding war happening for high-bandwidth memory or HBM parts. This is a severe, dangerous mismatch between demand and supply. If the raw materials needed to build these servers are skyrocketing in price, Dell is going to feel intense, crushing margin pressure, and frustrated customers might eventually just walk away from the table entirely. Let's drill even further into these exact supply constraints because a chain is only as strong as its weakest link, right? And right now, Dell has several major vulnerabilities. They specifically called out severe shortages in DRAM memory, NAND flash storage, traditional CPUs, and even regular hard drives. Every single one of these components is a vital, non-negotiable building block for an AI server. To put this in perspective for everyone watching, you can have a state-of-the-art, liquid-cooled AI server rack just sitting on the factory floor, fully assembled and worth $300,000. But if you are missing a single $500 NAND flash drive, you literally cannot ship the unit and you cannot recognize the revenue. This commodity constraint is a massive structural vulnerability in their entire hypergrowth narrative. Okay, those are absolutely valid constraints, I'll give you that, but you are entirely missing the underlying fortification that's happening across the rest of the business. Let me explain this AI drag effect that management highlighted. The deployment of AI isn't just about plugging in specialized servers. Agent AI and inference workloads are actually driving a massive 92% surge in traditional server demand as well. Think of this using a construction metaphor. GPUs are the massive, heavy-lifting cranes on a job site. They do the incredible work, but they absolutely need traditional CPUs to act as the logistics managers on the ground, telling them exactly what to lift and where to put it. You simply cannot upgrade the cranes without also upgrading the managers. The entire data center foundation is being completely reinforced from the ground up, and that is driving a broad-based, long-term infrastructure supercycle. And hey, if you want to talk about true structural integrity, just follow the cash. Dell generated a first quarter record of $4.1 billion in operating cash flow. And what exactly did they do with that absolute mountain of cash? They returned $2.1 billion directly to shareholders. They aggressively bought back 11 million shares at an average price of $147, which effectively puts a massive floor right under the stock.
And they paid out a 63-cent per share dividend, a dividend they just raised by 20%, by the way. Look, a company facing imminent structural collapse does not authorize a $10 billion share repurchase program. It takes immense confidence from a board of directors to aggressively buy back stock at those elevated price levels. It completely proves that management fundamentally believes the stock is deeply undervalued relative to its massive future cash flows.
Okay, so they're buying back their own stock. Fair enough, but let's formally introduce our Follow the Money segment. Retail investors routinely get trapped by flashy headline numbers and these aggressive corporate stock buybacks, while the actual institutional and insider data reveals the true structural health of the asset underneath. If this is truly the generational wealth building opportunity you say it is, we need to rigorously look at what the smart money is doing. Are the institutional heavyweights and the corporate insiders actually forging ahead with this hypergrowth narrative, or are they quietly fleeing the construction site while everyday retail investors are left holding the heavy bags? Let's drill directly into the actual SEC filings. Well, the institutional data actually shows massive accumulation from some of the absolute sharpest firms on Wall Street. Take Jane Street Group, for example, a massive quantitative trading firm acting on advanced algorithmic momentum. They increased their position by an incredible 654%. They scooped up over 5.2 million shares. And Goldman Sachs, they heavily added 2.6 million shares directly to their vault. Market Skeptic, hold on. Let me counter that with some brutal reality. Morgan Stanley just completely dumped over 5.2 million shares, brutally cutting their position by 44%. Wellington Management, they dumped 1.6 million shares, representing a 61% reduction. These firms might be aggressively taking profits for fundamental risk management reasons, signaling they heavily believe the top is near. Even JP Morgan and Deutsche Bank both slashed their holdings by over 40%. The institutional site isn't unified at all. It is totally fractured and divided.
But honestly, the real sledgehammer here is the insider data. I am dropping a massive, unignorable red flag on the desk right now. Over the last 6 months, corporate insiders at Dell have executed exactly 348 sales of their own stock on the open market. And how many shares have they confidently purchased in that exact same time frame? Absolute zero. Not a single insider has reached into their own pocket to buy a single share of their company on the open market in half a year. That is a glaring, massive lack of confidence that you simply cannot ignore.
Let's brutally interrogate this C-suite sell-off for a minute. COO Jeff Clark, the exact same guy warning us about the severe inflationary constraints, he just took 116,000 shares, roughly $21.1 million, cleanly off the table. Board member Egon Durbin, he sold 71,000 shares for $9.8 million. For context here, Egon Durbin is the co-CEO of Silver Lake, the heavy-hitting private equity firm that literally helped take Dell private and then public again. He knows this blueprint better than literally anyone else alive. The chief customer officer also casually sold $23.6 million. If this company is structurally bulletproof and absolutely destined to dominate the AI era, why are the chief architects and foundational investors eagerly selling out of their own building? That is a fundamental structural crack in the foundation that retail investors are just completely ignoring right now. Look, insiders sell for a million different reasons. Taxes, portfolio diversification, buying a mega yacht, you name it. But let me actively defend the foundation by pointing to what actually drives long-term market valuation: forward guidance. Management just raised their full-year fiscal 2027 revenue expectations by a staggering $27 billion. They are now officially targeting a midpoint of $167 billion. To truly contextualize the sheer scale of that raise, Dell essentially added the equivalent of an entire Fortune 500 company's yearly revenue to its forward guidance in a single quarter. That is nearly 50% higher than the record $113.5 billion they generated last year. You absolutely do not raise guidance by $27 billion if you think your supply chain is actively failing or if you suspect your backlog is evaporating into thin air. And just to double down on that incredible guidance, I really want to highlight the core engine of this growth. Management stated that roughly $60 billion of that full-year target will be pure AI server revenue. That is up from just over $9 billion a couple of years ago. This categorically proves that their deal pipelines are not only fortified, they're actively accelerating. Customers out there are absolutely terrified of missing out on crucial AI compute, leading to a massive fear of missing out. Because of this, they are aggressively locking in multi-year supply arrangements that are up to 5 years in duration. This long-term lock-in essentially guarantees Dell highly predictable, ironclad cash flow for half a decade. That heavily de-risks the stock and firmly cements Dell as the absolute bedrock of modern IT infrastructure. So, it's finally time to synthesize all this data and render a verdict. From an analytical, data-driven perspective, Dell presents a generational wealth forging opportunity. They've masterfully constructed a massive, cash-generating operating model on a solid steel framework, heavily fortified by a $51 billion backlog. They're aggressively returning billions to shareholders while completely dominating the enterprise and neo-cloud AI transition.
And from the skeptical, grounded perspective, I am heavily warning you about severe structural commodity constraints in DRAM and CPUs. There are brutal inflationary margin pressures that threaten to squeeze their profitability and a highly concerning pattern of massive insider dumping. The building looks incredibly shiny on the outside for sure, but the raw materials required to actually finish the construction are getting dangerously scarce and highly expensive.
Which leads us directly to our final, provocative thought for the day. I really want to challenge everyone watching this explainer to look hard at your own portfolio construction. If Dell's foundation is truly as unshakable as the headline numbers suggest, why are massive institutional players and the company's own founding architects aggressively heading for the exits, while everyday retail investors are eagerly piling in to buy the roof at all-time highs? Are you genuinely buying structural steel today, or are you just catching a falling knife at the absolute peak of the AI hype cycle? Let us know your thoughts in the comments below, and we'll see you in the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.